In this episode, Ryan and I discuss why one would consider becoming their own banker. But buckle up, because we covered an awful lot more ground than that. All right, welcome to the Banking with Life podcast. I'm your host, James Neathery.
And I'm your co-host, Ryan Griggs.
And we're just having fun talking about different things and inviting you in to listen, and we appreciate that you are listening. And what are we going to talk about today?
Well, we get into the weeds a lot about addressing certain either questions or objections or
clients.
Exactly.
Client calls.
What people say. So, the viewer can see what previous podcasts are about since whenever this one comes out. But what we've not done so far, I don't think, is just talk generally about why somebody would consider infinite banking, why they might study the IBC, why they might consider implementing it. So this is just a review, really, a discussion of what we believe to be the reasons one might get into IBC. And I think we said beforehand, we're not going to cover them all because this podcast won't last the whole weekend.
So this is August 17th, right?
Yep, 2019.
Yep, 2019. So maybe this will be out by November, December.
We don't know.
So really it's why should I do IBC? Why should I even consider the infinite banking concept? Mm-hmm. Which I think that, that's a fair and legitimate question. And we won't be able to unpack that in one podcast. There's no way.
Well, it's a necessary question too, because it's important to frame how you think about the IBC correctly first before you take to the internet, like the many bloggers out there who offer their alleged expert opinion on infinite banking without knowing even what the proper way to think about it is, right?
Yeah, but one would not have to properly classify their thinking about money to consider the infinite banking concept. However, once you entertain the idea of considering the infinite banking concept, you'll quickly discover that most of what you read out there, unless you're reading Nelson Nash's book and his work and the work from the Nelson Nash Institute, and might I say our work, you're gonna the confusion is going to be compounded, in my opinion, because there are a lot of people talking about the infinite banking concept that maybe should stop talking and start reading or learning before they resume talking. And I'm not naming names or pointing out blogs or articles or videos, but personally, Ryan, I count on the listeners, viewers' ability to separate the wheat from the chaff. I say it all the time. I mean, I count on and rely on the clients, my clients, your clients, our clients, their ability to separate the BS from, I count on that. So
yeah, I'm
just saying that once you do start entertaining the idea of, man, I want to research, I want to find, is this really as good as it sounds or as good as it can be? Is it really worth considering? Yes, it is. And I'm just saying, once you make that decision and you do the research, just like you mentioned, whether it's in blogs, and if you're reading, a shameless plug. If you're a reader, you prefer reading, you should go to medium.com.
Yeah. So I have a blog on a website called Medium. It's medium.com / Ryan D. Griggs. Or really, if you go to Google, you type in what is infinite banking, and put my name after there. One of my blogs should pop up on the first page.
Above the fold.
I don't know. I don't track any of that stuff because I don't care.
Well, what'd you pay for that?
But nothing, of course.
I'm kidding.
But I think I am the only one on Medium talking about infinite banking. I certainly am the only one talking about it as much as I do.
Sure. So if you're a reader, Google Ryan Griggs and infinite banking concepts, or just go to medium.com and search Ryan D. Griggs.
I've had people email me and say, I've read one of your blogs about capitalization versus investment, and I went down a rabbit hole.
Yep.
And read 7 more. It's like
Well,
perfect. Let's schedule your application.
Well, that's really what happens. Typically,
Yeah.
if someone's interested in learning more about the infinite banking concept, the individual that is really, getting past the cursory videos out there that have the smoke and the mirrors, the pixie dust and the fairy tales and the rainbows and the unicorns, like, oh, if I move money from here to here, all of a sudden I'm going to be wealthy. If I leverage a life insurance policy to the nth degree and maybe buy another policy with that leverage, when you get past all of that, and if you continue searching, I have found you typically wind up at the Nelson Nash Institute in some way, form, or fashion. You get to the fact that Nelson created this concept, right? And then he added scale to life insurance, and I'm speaking directly to some things that are out there. So, oh, Nelson didn't create this concept. You could listen. You can borrow against anything, and if you have equity in your home, if you have equity in farm equipment, if you have equity in a life insurance policy, which is what cash value is, there's a loan provision in that policy. Is that something new? No, that is 200-300 years old. What Nelson did is create the infinite banking concept. So once you start down the rabbit hole and you wind up at Nelson's website, infinitebanking.org, not the infinitebanking.com that was hijacked. Okay, infinitebanking.org, the author, the genesis of the infinite banking concept. Then I see that they typically see an association that I've had with Nelson, and then they may reach out to us. So for the researcher, the one who's really looking, you're going to see clearly that Nelson created this concept.
Yeah.
All right. I'm just saying you got to walk over a lot of stuff to get to the good stuff. I mean, and so my encouragement is to keep going, keep researching, keep digging, and swipe left whenever you suspect that, something may not be clear, and it's okay.
Yeah. Right, if something feels off, it probably is.
Yeah.
Looks like a duck, quacks like a duck.
Has wet feet.
Yeah. It ain't a deer.
But, there is a lot of stuff out there that adds to the confusion or doesn't bring clarity.
Yeah.
Or misses the whole point. Nelson never railed on and on or even a little bit about interest rates ever. He clearly says this is not about interest rates. So I don't know why people have to try to make it look better than it is, trying to make policies extremely efficient by contorting the fire out of them to get an internal rate of return up. And I mean, that's just adding to the noise that is out there, in my opinion.
And I really do think the problem is, and I think that the industry's accountable too, the life insurance, home offices, they're also guilty, maybe by not necessarily maliciously, but for whatever, like you say, Nelson's the one that created the concept. It wasn't the life insurance companies. And I think the reason is that we just don't understand what the IBC is. We don't understand why someone would do it. I guess the purpose of this episode. And for me, it comes down to the idea of capital, access, and control over capital, the qualities of the asset in which you might strategically, intentionally build capital. Right? What are those? Why would you want to build capital on one asset instead of another? Right? What sort of things might you look at? What criteria might you use to analyze which asset would be better? Right? Like you said earlier, you can bank with anything. You can borrow against anything that's got equity in it. Right? The house, the business, what have you. But why would you choose one instead of the other? Right? And are there criteria you can? I think the answer. I'm not trying to play games. I think there are definite criteria you can use to analyze. Okay, which asset would be preferable? How do I maximize the value, optimize the value that I would get out of a certain asset, in which I'm going to intentionally build capital, right? And then the second part of that is understanding that a capitalization strategy, the idea of building capital, is not investing. We're not investing. And I think that's another reason, like the people that we're not mentioning, but mentioning him, mentioning
we're talking about without mentioning.
That one of the issues is they approach infinite banking with that conventional financial planner or investment analyst mindset, where they try to consider, like you said, the rates of return, internal rate of return, all that kind of deal. Things you would use, criteria you would use to analyze investments, but we're not doing that. But I think it's as time goes on, it becomes more and more clear why that's the case.
Well, I think that we're not mentioning anyone. We're not talking about anyone.
It's not about anybody else. Yeah, it's just about the in general, ideas out there.
The what is out there, and I have to live in the world of simplicity. It helps me. It's a virtue: simplicity, brevity, clarity. The fact is, banking is all right. Banking, the movement of money. Money in, money out, deposits, withdrawals, checking, savings, just the movement of money. As a matter of fact, we've all heard that, the oldest profession in the world, and I disagree. That what we commonly think is the oldest profession in the world is not the oldest profession in the world, because somebody financed that. I think banking is the oldest profession in the world. So my point is this, and Nelson said it often, banking is, and somebody is performing the banking function in your life, and they're profiting from that.
Yes.
This is about banking, right? And so, yes, now we get into assets. You can bank with anything. Why did Nelson, use dividend paying whole life insurance?
Well, before you jump off that, let me interject, because it took me a while for that to sink in. Like banking is, and okay, it's a business, and businesses, if they stay around, generate a profit. Someone gets paid the profit. Who's getting paid that profit? How do they get paid that profit? Right. So, people should understand it's a legitimate value added service to advance a sum of money. Banking time to the individual, to lend somebody a chunk of it's giving you purchasing power you otherwise didn't have, right? And okay, if that's a value, and it is, then there's a price for it, and so you're going to pay a price, and so whatever the entity is that's doing the lending is collecting revenue for the service of extending loans of banking. Okay, well, if they're making some revenue, they're probably paying some people. They have expenses. Take the difference between revenue expenses. They
have
income.
gophers in the home office, in the headquarters, or in the main office.
And then somebody owns the company,
right?
And they're the ones receiving or participating in the positive financial performance, right, through the receipt of a dividend.
You mean banks pay dividends?
Okay, now go around to how many bank customers, businessmen with lines of credit at the bank, mortgage debtors.
No, somebody owns that mortgage.
Yes, but how many of the people who are repaying those loans are also receiving the dividend, are also benefiting financially from the fact that they are engaged in this bit that everyone's engaged in?
Well, now wait a minute. Let's think about that, because you're getting to the point that banks pay dividends, right, to the bank owners. Most of us do not own banks, so we don't receive those dividends. Right. But now if I finance, real estate through a publicly traded company, right, so I'm paying them the interest on the mortgage, I can go buy their stock if they're publicly traded, and I may get a dividend or a stock value appreciation, right?
Tax at ordinary income rates.
No, I can get capital gains on that.
So, yep.
Yeah. I'm just saying, but it's complex, and there's not any. There's not any particular banks that I want to go own or buy stock in. I'm just saying that it can be done, but it's a convoluted way to do that. You can do that if you want to, but man, if I'm running a business, why do I want to invest in another business? Why would I even want to go through that whole process? Because I like stocks. I believe the values are going to go up forever, because all the markets are manipulated. So I'm just saying that I'm just recognizing the fact that you could do that if you wanted to, if that publicly traded mortgage lender pays a dividend. Who knows if they even do? I don't know. Okay, I didn't mean to derail you there, but
No, that's a good, valid point. But and then you bring up the next logic one is why not just own that and why not own that function yourself?
No question.
Right? And why not, even easier, why not be an owner by virtue of being a borrower, right? Why not be part owner of a company, of the entity performing the banking function, simply by virtue of doing business you were going to do regardless, right?
Yeah. Look, if you think about that, you referenced a business owner. It doesn't matter if you're a business owner or a family. Every family in America needs access to capital. Every business around the world needs access to capital. Who's controlling that access? It speaks directly to the banking function. Businesses need access to capital to function and be profitable. Who's the gatekeeper that's controlling the access to that capital? It speaks exactly to the very reason why should I consider? Why should I even, go down this rabbit hole and learn about the infinite banking concept? Why should I become my own banker? Why? Because of that's just one characteristic of the infinite banking concept, is I'm controlling my own access or the access to capital.
By contract. A legal contract.
That's another virtue.
Yes.
Right. Why should I consider the infinite banking concept? It's based in contract law.
And fully private property.
Fully.
Right? Not a tax qualified plan. It amazes me that we see the post office and the DMV and just normal people who aren't interested in political philosophy or whatever, but they see the problems in the education system and the healthcare system and you name it. Anything the government's got its hands in is corrupt and inefficient, right?
I'm shocked.
But then we come to tax qualified plans and it's like, take my money. You can't get enough I can't buy enough of this. Yeah. Oh, I have a limit. I can't pay more. I can't get further into bed with the government for the third most important thing after God and family, namely your future, right? Your money. I just don't people who just jump clear over that.
Yeah, and we've kind of talked about, I reference that as the paradigm, the construct that we're all born into without a choice. We're surrounded by this noise, this constructed noise from cradle to grave. Yes. And if you think, okay, so James, you're a conspiracy theorist. No, I'm a student of history. Okay, and let me just digress for a moment. Mm-hmm. There's a documentary that came out a couple of months ago that They shall live forever. They shall remain. It's a British movie. So the British Museum of History reached out to an award-winning filmmaker to do a documentary on World War I. All right, and I can't remember the guy's name. I'll try to find it and put it in the notes and links. Right, They Shall Be Remembered. It was a limited release, so we went, my boys and I, and so World War I. If you think about, out of all of the armies around the world going to war in World War I, huge loss of life. How did those young men that were 17, 18, and 19 years old go across the world and fight against these Germans that were going to invade us? If you think about that, if you think that through, and I've read a lot about Nelson was. He got off on
Nelson was huge into this.
He was. And there was part of the three projects that he was working on, there was some connectivity to one of those projects.
Nelson knew more about military history and war than professors of the subject do.
Oh, no question. And okay, so my point is this. How did so many men in Europe, right? England, France, Belgium, Germany, the U.S., Canada, Australia, New Zealand. How did all of these young men just line up to volunteer to go to a great world war? They were surrounded in the noise from birth that the Germans were bad people and needed to be destroyed, and they were going to invade us at any moment. And they didn't have the ability. And I should cut this out. But I'm just saying.
It's good. As you can tell, unscripted. But it's not just that war; it's all of them. Any government war is just a big government program, right? So
big government program.
There's always a.
But now you're being political.
But you're right. There's always a construct, and we're embedded in one. And the financial construct that we're in has no place for capital, to address the importance of access to capital. We don't even think about it.
We don't think about it, and it's too complicated. I don't know what to do. That idea is coddled and promoted by the financial world.
Yeah, yes.
And then people is like, well, it's always easier to do nothing. I mean, it's always easier to do nothing. So I understand that. I'm human. I need as much discipline as probably more than most people. Oh yeah, thanks a lot. But when you mentioned the qualified retirement plans, the traditionally qualified retirement plans, you can't put money in that fast enough. Everybody else is doing it. That's the message that we get from all the talking heads in Wall Street. But then the second place that you can't put enough money in fast enough is pay down the mortgage because you don't want to pay the interest, right? So the majority of the Americans' equity is in the stock market through qualified plans, and then in their equity. Now, who's controlling the access to all that capital? Not you.
Nope.
Right? And then if you're running a business or a household and you need access to your capital, your money, so you can become wealthy or live comfortably, in retirement.
Whatever. Yeah. Literally whatever. And so I want to make one point that if you thoroughly investigate, reread about the infinite banking concept, it may be possible for the all-American average family to just live their life making the major purchases that they were going to make anyway, financing them through a dividend-paying whole life insurance policy structured correctly with a mutual company that understands what's going on. And so it just may be because everything in the financial world is compared to what? Okay, and I'm just making a point that the all-American average family business owner, may come out pretty well just financing your major purchases as compared to all of the other noise and encouragement of what you're told to do with your money from the investment world. Mm-hmm. Now, think about that and let that sink in. And if that's true, you should know about it. And if it's not true, you should do enough research to mark it off your list as not true. Absolutely. Even someone who's like, oh, this IBC stuff. I mean, I think it should be clear now that it at least deserves a full hearing. You should at least fully vet and get all of the questions answered before you move on from it. And I want to come at this from a different way. So suppose that you're like, oh, Ryan, investing versus capital or whatever. Suppose you just want to do well with money in life, right?
Oh, okay.
And then we want to have the successful investments that produce a high return and all of that, right? How best should we approach the financial world? Well, you can do so from a position of little access to capital or from substantial access to capital. And this dichotomy is not even on the table for most people when they're thinking about how to approach investing. What do we need to do before we even get there? Because most people, just by default, approach investing from a position of severe undercapitalization, very little access to capital, right? Make the money, earn income, and as quickly as you can, go invest it, right? Without at all exercising any control in the interim period. Just dump it into the tax qualified plan, get it into the mutual fund, right? So says the conventional financial paradigm.
We got to take advantage of dollar cost averaging.
Oh, So the result is, in that world, a few things. The investments that you're going to lay eyes on are going to be relatively limited in number, right? You can think of the list of the potential investments that the employer might give in the tax qualified plan.
Well, if we're talking about qualified plans, now you have to opt out, right? When you
okay.
Also, get employed,
all sorts of problems.
And then you're the default is a target date fund.
Yep.
Right. Mm-hmm. So then beyond that,
an algorithmically traded mutual fund. Okay.
That's weighted between equities and fixed or bond positions. So, and then the older you get, that the bond portion of the portfolio is greater than the equities portfolio.
Just consider that. You got these few money managers on Wall Street who have access to tens of trillions of dollars in these algorithmically traded mutual funds. I wonder if they're going to trade those assets in their favor or in the favor of the owners of the asset.
I can't even believe you had questioned.
I wonder.
Is that the integrity of the motive
I'm
or
just
the
curious.
application?
It's a curiosity, really. Okay, so we've got this list of tax laws. They're relatively few in number. Okay, they're going to be relatively homogenous, right? It's all basically the same deal with a different brand name slapped onto it, right? This kind of portfolio or whatever the little special marketing names are. They're going to be mass, if not globally marketed, right? So a huge population is purchasing into these things, right? So consequently, the returns are smaller than it would be if you had access to a local, exclusive, unique investment opportunity, right? So my point is that even if we want to talk about investing, we have to ask the question then, okay, well, how best should I approach investing in order to get the best set of opportunities? Well, the way to do it is from a position of high, substantial, contractual control over capital. And I just don't think you can disagree with that. People say that it takes money to make money, and they say that's why people say that because they want a reason for why they don't make a lot of money. And so they say, well, it takes money to make money, and well, if you don't have a lot of money, then you're probably not going to make a lot.
Well, until you get into the real estate world, all the gurus, you can become a gazillionaire, without any
ever
money.
Leaving the house.
It'll be mailbox money. You could be on the beach somewhere, and
I'll just send you a check.
Apartment syndications or whatever. We'll show you how.
No management problems, nothing. But my point is that's not necessarily true that it takes money to make money. I mean, what it takes is a capitalization strategy and the discipline to implement and execute it.
Now you're talking discipline. That's one of my favorite words.
I know it is.
I mean, it is.
I think the word abdicate is also another favorite.
No
abdication of the responsibility to accumulate capital.
Well, now look, if I put, if I don't opt out of a qualified plan, and I'm not telling anyone to opt in or opt out of a qualified plan. We're just discussing what's going on in the big wide world. Okay. If I just go along to get along, if I'm just paying down the mortgage, which there's nothing per se wrong with that in particularly, and I'm getting the free match, the free money from the employer because I'm participating in the qualified plan, and it's all too complicated anyway, so I don't want to worry about it. My brother-in-law is a financial expert, money manager. Aren't I abdicating my responsibility in some form, some level? Yes. All right. In that, a side point, one of the favorite things, one of the most common things I hear, and it's a default. Well, you got to have money to make money. Mm-hmm. Well, I have a financial advisor. In my internal question, and sometimes I can't reframe, and it becomes external. But yeah, but are you doing what they're telling you to do? Are you doing what they recommend? Then the deer in the headlights like, no, but I have one.
And that mentioned conventional financial advisors. I mean, I think they're part of the problem. And not intentionally, but you look at if you have some extra time on your hands, Google.
Oh, we all have. We're dripping with extra time. I mean.
Okay, well, then take my word for it. Either take my word for it or go Google it. Pull up the various financial industry designations that one can get. Go find the particular college that issues them. Look at the coursework for those designations. Find the section on economics and go look at what's taught there.
And who's it based on?
Right.
You've mentioned their name.
Nelson always used to talk about how, for the longest time, it might still be the case that it's probably now Greg Mankiw, I would bet, but for the longest time it was Paul Samuelson. They were using his textbook. This was a supporter of the Soviet Union, Nobel Prize winner though, right? So whatever he says goes.
Wasn't Maynard Mr. Keynes?
So Samuelson was a follower of Keynes, and Keynes also, by the way, a pedophile, right?
Oh, no question.
Yeah. But so it's my point.
Well, why
is
are you going to pick on him? I mean, if we're going to talk about that.
No, don't go down that rabbit hole. My point is that what they're taught doesn't allow for. There's no theoretical or intellectual space to even get their arms around what it is that, to even get their arms around what the problem is. I mean, I don't even like discussing tax qualified plans in the same paragraph as IBC, because people get to think that, oh, you could do this or that. You could do IBC or tax qualified plan. No, they're in two different categories. The tax qualified plan is an investment strategy. It's something else. IBC is about capitalization. It's categorically distinct, right? Theoretically, you could do IBC, build up substantial cash values, take a policy loan, go to town on your mutual funds, right? So you could do both. There's just evidence that they're not alternatives.
Well, then it would be my choice on what I do. If I wanted to do the mutual funds, or I wanted to do my wife's new car, or my granddaughter's education, or whatever, or all.
Yeah.
And I got to say, look, Keynes had no problem with access to capital. Being the government crony he was.
Yeah.
I mean, he can't. How can you? And being a pedophile, how can you even? How can you even think? You're not even thinking. You're mentally not even. I'm sharing my opinion. Someone like Keynes wouldn't even have the ability to think like you or I or the all-American family.
I agree. Okay, so maybe we could. Maybe it's okay. Yeah, maybe you've listened to other podcasts. You listened to the last half hour, however long we've been talking to you today, and you're convinced. Okay, well, maybe there's something to this. Maybe I should be building capital. Well, one question you might ask is, where should I do it? Okay, well, IBC takes place through dividend-paying whole life from the mutual life insurance industry. So on the one hand, dividend-paying whole life is older than the country, right? It's a very old idea, and it hasn't changed much. There's all sorts of financial engineering to attempt to mutilate it along the way, but at the core, ordinary dividend-paying whole life insurance from a mutual insurance company still has basically the same characteristics that it's had the entire time it's been around, right?
Sure.
So you might say that it's a tried and true asset in which to build capital. And then you look at the life insurance industry, these mutual companies that provide the product have been around for over 100 years, many of them. Not all, but many of them, right? And they've also paid dividends for each one of those 100 or more years, right? So think about that. Companies in one of the oldest industries in the world that have probably one of the best track records when it comes to consistent positive financial performance. Okay, well, where else could be better
let me
build capital?
Expand on that if I can. Over 100 years, here it is, 2019, right? And most companies, just like you're referencing, has paid a dividend. That means that they had a positive financial experience in the year that they pay a dividend. All right, now let's look at that. And this is not comprehensive, but cursory. 1893, a panic. Then you had South Africa, the genesis of World War I.
Mm-hmm.
All right, then you had a panic of 1907.
Mm-hmm.
Then you have 1910.
Mm-hmm.
All right, and then you have World War I. Okay, and then you have the panic of 1920, 1921, and I think Dr. Murphy just wrote an article. I haven't read the article. I've seen it. The depression that you've never heard of, something like that. All right, and then you have the crash, the depression, 1929. All right, and then, oh my gosh, there were some shenanigans going on too in the early 30s, 31, 32,
Mm-hmm.
33. The Gold Confiscation Act, the Banking Act of 1933. All right, then you have World War II. Then you have the Korean War. All right, then you have, let me see, what do you have after that? You had a market correction in the early 60s. Then you get into the Vietnam War and the oil crisis.
Yep. And the Bretton Woods.
Bretton Woods Agreement.
71.
44. No, 71. We just passed the anniversary of April 15th 1971 when Nixon slammed the gold window shut. What a deal to us. Oh my gosh. We're not going to sell you gold at $35 an ounce anymore because we already shipped it all to you. Okay. The monetary shenanigans that were going on. We fully came off the gold standard in 1971, April 15th. All right. And then the late 70s. Well, we had stagflation around there.
80s,
right?
Yep.
Then we have 80 and 81. Right, we have some market panics in 87 and 89, and then in the early 90s, and then the recession or the dot-com bomb, whatever, 2000, and then 2008. And these companies, when you say, and they have paid dividends for over 100 years, I'm just pointing out some of the
through
monetary
all of that
shenanigans. And did you know, and I don't have a documentation of which company, but I'm under the understanding that a life insurance company paid dividends in gold in 1930.
I'm sure they
31,
did.
To make a point. I mean, so I'm just drawing out over 100 years, these companies were successful, profitable, and because the policy owners or part owners of the company, they paid dividends. And now what are you going to compare that to? Give me any other industry, any other, institution that's not a government contractor or a NGO, right, that's been that successful.
Well, I've been asked before, just theoretically, could you do IBC in the way that you can do it as optimally as you can in dividend paying whole life with any other asset? I mean, we have touched upon that you can borrow against the value of other assets. We get that, right? But beyond that, the perfect collateralization idea, the notion that when you borrow against the value of the asset and the lender of that money is also guaranteeing the value of the collateral, okay, when that occurred to me, it's like, let that sink in for a second. It doesn't happen anywhere else. Anywhere else. It's only in life. So it's not as if this is a gimmick for life insurance sales. It's not that we happen to be life insurance people. It's like, IBC is a way to talk about it.
Listen, don't pigeonhole me just because I write life insurance. I'm a father, a brother, an uncle.
What I'm saying is that
business owner.
We can, if the idea
mentor,
of capitalization matters, and
student.
It does. Oh my gosh! If the idea of capitalization matters, and it does, then it becomes a matter of where is best to do it, and in what asset should we do it. If you go through the list, you end up at dividend paying whole life, built appropriately.
Right? My addition to that is the lender is guaranteeing the underlying asset.
Yeah.
That, think about that for a minute. Beyond what, they cannot make bad loans. They do not make bad loans. I'm not saying they can. The life insurance company does not make bad loans. Number one, they're uber conservative. Now I'm specifically talking about policy loans. Mm-hmm. It's 100% collateralized. All right, 100. The loan is 100% collateralized. Now, this is a company that you're an owner of, lending money, and so those loans are 100% collateralized. And then even the loan growth, the compounding of the loan, if interest is not paid on the loan is going to compound. Right. Well, the outstanding loan is ultimately collateralized with the death benefit.
Wait, I have to pay interest on policy loans?
That we've talked about that. Yes, you do. And
wait, I can directly contribute to the revenue generation of a company I own that pays me a dividend?
I can directly
do that?
Support the profitability of a company, therefore indirectly supporting the profitability and the stability of my policy.
And the growth of my capital?
Wait a minute, and I can get it cheaper than, 18, 20. I see lines of credit at 9, 10, 12, 14%. And these are, I'm like, legitimate businesses, right? And I'm like, why would you ever pay that much? Well, because it was so easy, it was uncollateralized.
He's been my banker for years.
Yeah, it was just Okay, I want to go back to the Nelson And he tells this story, and I know most of the people listening or watching have read Nelson's book, Becoming Your Own Banker. And my encouragement is to go ahead and read it again. He discovered that life insurance, after paying high premiums, he was paying $18,000 a year in premium. And I know we've talked about this, but not everybody listens to everything we've done. So Nelson here
repetition.
In 1980 was paying $18,000 in life insurance premium. A.L. Williams would stroke out if he knew that. He could, okay.
Usually I'm the one name dropping.
God bless A.L. Williams. He's last I heard, he's off the Florida Keys drinking Mai Tais, mailbox money. God bless him. All right. I think your point, and now I'm specifically talking about what went on in the 80s when there was a collusion between the senators and the term peddlers and Wall Street to beat up single premium life insurance. And I'm giving you the background because Ryan Griggs made the great point that the only thing worse than a weak argument is a weak defense. And the life insurance companies, my gosh, delivered a weak defense. Okay, now.
Rolled over and played dead.
I think they were paid. I know some of those companies were demutualized shortly after that. I mean, come on. We can connect some dots there without. Okay. All right. Nelson, after paying $18,000 a year in premium in 1980 as a real estate investor, he did one deal. He never seen the property, and he took his family to Europe for 30 days off of the profits of one real estate deal. All right. But, oh my gosh, something happened that he couldn't control. And I jumped smooth over the Resolution Trust Corporation in the late 80s in the oil crisis when I went through that list of monetary and economic oddities or turmoil. Yeah. Okay. So interest rates go sky high. Nelson's leveraged out the nth degree in real estate. A man who understood real estate and leverage and money and sound money. Okay. And all of this is in his book, Becoming Your Own Banker. But what he leaves out of that, there was partners in the deal that when the economy went bad, interest rates went really high. One of those partners bankrupted on him, and he doesn't talk about that in his book. So what he's showing in his book, Becoming Your Own Banker, leaves out that $700,000 partner that filed bankruptcy. And Nelson didn't file bankruptcy. And that's part of the reason it took him 14 years to get rid of the snakes and dragons. Now, you just $700,000 today, you think, well, that's no money. $18,000, that's not a big deal. This is in 1980. So, I don't know, times that by 3. Now
at
we're,
least.
Okay, $2.1 million, somebody bankrupted. Now we're, okay, the man had some cojones. But because of all this great pressure, and there's some other things that happened in his life personally, because he was paying such high premium, $18,000 a year, he had a lot of cash value. And he had contractual access to that cash value, guaranteed by contract. So instead of paying over 20% in interest, he had guaranteed access to that capital at 6, 8, and 9%. So he quickly discovered, suddenly, right after all that pressure, life insurance has more characteristics of a financing entity, of a banking entity, than it even does of life insurance. Think about it. This is a life insurance product. And it has more characteristics of a banking entity than even life insurance. So that's the genesis. So, I'll stop there. I don't want to keep going and calling people out that, no, Nelson didn't discover it. Okay, well, you tell me what he did do. Right?
Yeah.
And he delivered. What he did do is add scale to what can be done with life insurance, and promoted this idea that you could become your own banker ever since, up until a couple of years ago.
And so one thing I want to point, it's valid to bring up Nelson, and one thing Nelson always brought up that so few people doing IBC today ever bring up is that if you are involved in the conventional financial industry, then you are part of the problem of fractional reserve banking.
Well, you mean if I
Okay.
go down to the bank and I'm asking for a loan, which, one of the tagline I think on your email address is banking is evil, or banks lend money that doesn't exist and that is evil.
In the final, so this is the last, I believe it is the last think tank Nelson spoke at.
Mm-hmm.
And I remember him getting up and saying point blank to a room of 160 people, most of whom were not as interested in anything about morality or political philosophy as Nelson was, right? And he says it point blank: banks lend money that does not exist, and that is evil. And it is. And so one big reason to implement the infinite banking concept is so that you can stop being a part of the problem. And it's not a trade-off. I'm not asking you to make some sacrifice for the greater good or any of that. We just went over the last 45 minutes not all, but many of the individual, personal reasons and familial reasons that you might do infinite banking. So it's not a negative trade-off. We're not asking you to sacrifice anything. But, by the way, when you do implement this value-added capitalization strategy that'll improve your financial performance, whatever it is you're doing otherwise, it'll add to it, right? When you do that, you stop contributing to the fractional reserve banking problem. And what do we mean by that? Okay, you go to a conventional lender, you request a loan, they'll put you through the ringer, ask you all these questions.
What is your number?
Get the credit check. Okay, so you limp out of that process, and then they grant you the money. Okay, well that money, prior to it being lent to you, didn't exist. Okay, if I were to lend money to James, if I were to lend money to James that I previously hadn't received from anybody else, we'd call that counterfeiting. Okay, so in the practice of fractional reserve banking, these commercial banks, these cardalized commercial banks, have the legal privilege to counterfeit money. Okay, that's what why is this important? Okay, that's what causes the business cycle. It's the reason we have recessions and depressions. So look, if you're thinking about, your friends and family, your community, the next generation, the generation after that, if you want to be a part of a solution to, I don't want to sound too grandiose, but to literally build a better world where fractional reserve banking is less of a problem.
Worthy goal.
Well, then getting into IBC might be the way to go. Is the way to go.
Yeah. I must say that Nelson, saying that, which is true.
He was unafraid to say it, is my main point. And
I just want to add.
Nobody else wants to touch it.
Yeah. Listen, they charge interest on the money that didn't exist when you sign your John Henry. So it's evil compounded.
Yes.
I mean, it's
so I lend money.
Beyond immoral, beyond evil. It's like, oh my gosh, what could be worse?
Couldn't get worse.
Being a pedophile like Cain.
And then when you fail to repay, I'm going to come take
real
whatever
assets,
property you have left.
Real assets that you have traded your God-given abilities and rights, or time, intellect, abilities. You've exchanged your time, which you've taken. I say this often. Look, if I'm going to spend 8 hours at work, I'm not spending 8 hours with my family. So I'm taking family time or whatever it is I'd rather be doing than working, right? And I'm putting my God-given abilities and talents and intellectual and health and in exchange for that, right? That value. And it's an equal exchange or a valuable exchange. I mean, I'm an ANCAP. Okay, I'm beyond free markets that don't exist. Okay, now that's real. Right, my education, my experience was real. It cost me to accumulate that. Now I'm exchanging that, giving value, delivering value, and I'm being paid for that value, right? So when I sign my John Henry, and this money is created out of thin air, and I'm going to pay interest on that money, that's fully collateralized, right? Oh no, it's an uncollateralized loan. Okay, your signature is a personal guarantee 99.5% of the time. And if you have a loan that is non-recourse, you're probably one of the boys, the good old boys club, in which generally that's not most of us.
Yeah. No.
Okay, so that uncollateralized loan, I'm collateralizing it with everything that I have created. I've exchanged my God-given abilities and talents to accumulate for the benefit of myself, my family, and Okay, think that through. It's beyond evil. So they're going to lend you money that didn't exist. And that money didn't, digits or money, right, that didn't exist until you signed on it. And then you're collateralizing that with real assets. That's, oh my gosh. And so when you get tired of that, that's a very good reason. You've been on Skid Row once or twice in your life. You're very tired of that. You know, you read Nelson, I mean, you can get very tired of that. Somebody else controlling you beyond your, you know, so there's some point in time that you come to realize it's like, oh my gosh, we really are living in a paradigm. And once you go down that rabbit hole and you're like, I'm not interested. And maybe there was a bankruptcy, or I've not filed bankruptcy ever. I mean, I've been on Skid Row a couple of times in my life and I don't like it. Right. And so I don't want to be. So once you've gone through some hardships, and if you're in business, you've gone through some hardships, you've needed access to capital that somebody else controlled, and therefore you didn't have access to that capital, or it came at a very high price. And when you kind of get tired of it, you know, that's a very good reason to start maybe considering that there is the idea, there is the ability to become your own banker. All right. And
Wait,
then
I have to read a book.
Yes. Oh my gosh. More than one would be okay. And reading some of those books more than once would be preferable. Now, let me say, once you get going down this idea that, look, if I put money somewhere and I can get all of my money back, I mean, that's a win in today's financial world. Okay. If I can get more out than what I put in and have additional benefits, that's even better.
Wait, on a guaranteed basis?
Oh my gosh. And then, you know, this not knowing what to do in the financial world, the infinite banking concept gives you clarity. It gives you a path. It encourages and supports your discipline. Yes. Okay. And then it's better than most of us realize until we get going down the path, because typically when somebody starts, you know, we're always looking over our shoulder like, this is too good to be true. What's wrong with this? What am I missing? You know, is Uncle Guido going to show up? But once you pass all that, it gives you confidence. Right? It's like, no. This is not only okay to put money into a properly structured life insurance policy. This is the place my money should reside. Number one, right? Okay. And then, oh my gosh, when your confidence level goes up and your comfort level goes up, and now all of a sudden, I don't give a damn what my number is. You want to judge me by a credit score? You seriously? Oh my gosh. And then, wait, I don't have to be part of the problem. And I'm not saying that we can't, you know, we can become our own banker overnight and finance everything that we're ever going to purchase in life. No, but I'm going in the right direction.
Greater than zero.
All right.
As you were talking about that.
Wait, but then it brings clarity. Now, I don't know what to do. No, I do know what to do if I want to, because I have access to capital. And I don't care what the market's doing, what the interest rates, neither of which you can control and that are completely manipulated. I mean, I don't have to live in a manipulated financial world. What is that worth?
Even in this chaos, even in this monetary chaos, you don't have to be a part of it?
And then here I am. I have children and grandchildren and maybe great-grandchildren.
We hadn't even talked about that.
Right. So, okay.
Yeah. Okay, so you accumulated all this capital. Now, how about the next generation? Right? Pass on mass. Even the people who don't understand life insurance understand that life insurance is the best way to pass on capital to the next generation. And then you end up passing on more than you ever would thought you would in the first place.
Oh, that's one of the first things I discovered with the infinite banking concept. You know, look, I've been in the financial world over 28 years, life insurance agent, blah, 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 blah. I discovered about 3 to 5 years into my infinite banking practice, which is, you know, been doing this for 15 years. And so you would think I would know this. I'd practiced in the life insurance industry for 14 years, $1 Million Roundtable producer, active in organizations, designations. I mean, I'm participating. I am not sleepwalking. All right. This is one of the many things that I discovered. You wind up with more death benefit at natural mortality with the infinite banking concept than you ever would have sought to buy life insurance. You know, I'm going to buy $1 million in term or $2 million in term, whatever the case may be. When you practice the infinite banking concept, you wind up with more death benefit at natural mortality than you otherwise would have. And by God, if the life insurance companies didn't know that, I don't believe them.
Absolutely.
By gosh. I mean, gosh, if the life insurance companies didn't know that, I don't believe them. And I trust the life insurance companies about as far as I can throw them. But, wait a minute. It's a contract. Right. Now my comfort level all of a sudden goes through the roof.
Well, you talk about clarity and the simplicity that infinite banking brings. I mentioned it before, but I'll say it again, that I have a friend who, you get light bulb moments. Nelson used to say IBC is more caught than it is taught. And when somebody catches it, it's just like catching, you can see it on their face. It's like, oh my gosh.
It happened to you.
Click. Oh, absolutely.
It happened to me.
Yeah. And so light bulbs going off, and you can even hear it in their voice on the phone. It's like, yeah. So
the octaves changing.
Exactly. And so this individual, a good friend of mine, he's like, I get it. And then he said, it just makes things so simple. All you got to do is go out and use your God-given talents and abilities to go generate value for somebody else, serve others, make as much money as you want in your life, however much you want to do. Go do that, and then you know where to put it, right? Now compare that scenario with what is really an intimidation strategy in the conventional financial world.
No
right?
question.
The market is volatile. Nobody really knows what's going to happen.
There's at the you and me level, we don't know what's going to happen, but there are some people that may know.
Oh, sure, but you certainly don't, right? You, individual, employee, employer, whomever you are, you don't know, and the market's dangerous. If you glance at a chart of the S&P 500, you can tell that those swings are a little more dramatic than they used to be. There's a reason for that, but oh my God, it's a fearful landscape, and we're pretty much ignorant about how to navigate it. So in order to protect us from our ignorance, we should diversify, right? Give over control of your capital to somebody else, assets under their management, so all the trading and all the fee generation that produces can benefit somebody else and not you. And of course, a lot of that money's in tax qualified plans, so there's tax consequences to even trying to use the money, right? So everything is structured in this intimidating setting where you're backed into a corner, and people capitulate to it, and it irritates the life out of me. It's kind of like you're like the big kid on the playground, which I was, and other kids are getting picked on.
Mm-hmm. Oh my!
And you kind of want to go over there and just sort that out,
Uh-huh. Yeah.
It's the same kind of feeling I get. That's why I get a little excited about when I talk about it's a fear-based intimidation approach to getting people to give over control of their finances to somebody else.
Keep your head down. Keep going. Nothing's going on here.
It pisses me off.
Yeah. No, you mentioned bullies. When I was very young, I'm the youngest of 4. So, we all ran around with kids that were older than me. So I was bullied somewhat until my sister, squared them away. But as I grew up, to this day, I cannot stand a bully, period. Mm-hmm. And it is intimidating, the financial construct,
that is
on
exactly
purpose.
What it is.
But we'll give you a hug and make you not feel too bad so you can, engage this.
Well, we got to dress it up, right? So the nice cars, the nice offices, the nice suits, the nice scripted presentation that somebody else taught him, right? That she, whomever didn't come up with. Yeah.
Ooh, if I say these magic words, they're going to pay a premium or put some money in, make a deposit, make an investment.
It's just, and then, but I'll say this too. We're going to go there. Okay. On the one hand, the intimidation strategy of the conventional world irritates the life out of me. Mm-hmm. Then you go into the alternative financial practice world.
Oh my
where
gosh.
everything is rainbows and ponies. And it's just, we just want to help create value and work together and everything's great. And no, it's not. No, there's a whole system out there that is ripping you off, and it should irritate you.
It does.
And if it doesn't, then there's a lack of understanding. I'm just putting it out there, right? So it's not, fun and games. No, there's people out there who are malicious. The system is not designed in your favor. Nope. Don't know if that's news or not. But
but wait, I'm a fiduciary. Listen, we've gone over. I mean, we may have to wrap this up or, continue and cut it up, do whatever. And so when you say alternative, though, right, the alternative investment world,
yeah,
where the rainbows and fairy dust and leprechauns are. Does that exist in the infinite banking world too?
you really want to go deep, huh?
I'm just saying there is an alternative, cryptocurrencies, foreign farmland, European farmland, mango farms in Panama. There's a whole, there's a big world for well, it's true. There's a whole world out there of alternative investments, right? Yeah. So now we're talking about using life insurance, right? And it's a money product, in a personal economics. So it's kind of an alternative thought process to begin with whenever you get past life insurance and death benefit, right? Okay, so I'm just saying, does some of those rainbows and leprechauns and unicorns exist in the infinite banking world?
Oh, yeah.
Okay.
And then look, I'm not mad at anybody. Don't get that idea. I know it come off a certain way, and I'm sure that wow. But
no, wait a minute. No, here, let me expand on that. There are some people when we talk about different things, and we've touched on a couple of things in this podcast that we've expanded on in other podcasts, right? And so if we talk about a particular situation or concept or idea of what's going on, financial people kind of reach out to us and say, "Hey, are you talking about me?" And I'm like, "No, are you guilty?" So we're not talking about anyone in particular. Right. We're talking about
really not. It's the underlying ideas, and this is my problem. If everything is happy-go-lucky, unicorns and fairy dust, then to me that communicates that there's something's been missed, because there should be an edge. It should. If you're in the world of money, you should be a little pissed off most of the time, because the deck is not stacked in people's favor. Oh. And look, Nelson was a perfect Southern gentleman. He was kind and polite, but he also had the fire and the integrity, the character, the passion that he would use it. He would call out the problems. And look, Murray Rothbard, and switching over subjects a little bit, we get into political philosophy.
No problem. Yeah, let's get into political philosophy.
So my favorite economist, Murray Rothbard, Austrian school economist, his position was, look, to motivate the masses to get on our program, to understand libertarianism, to do some reading.
You've been wanting to talk about libertarians for a while.
I have. For only 1 hour in, too. So he used to say that, I'm not quoting it all, but his position was, when it came to any kind of marketing or branding or anything tactical or any of that, that he wanted to show people, to explain to them that they were getting ripped off. Yes. And you are. And that's how you motivate. That's why he was so successful, to the extreme irritation of the highly distinguished intellectual academics currently residing in certain universities across the country. That's why he was so successful as a promoter of libertarian political thought, was because he knew that in order to be successful, you had to explain to people how they were getting ripped off. And so my point to you is that same thing, that you're getting ripped off. And my dear libertarian friends who understand that already, I encourage you to start looking for a solution. And I did a blog recently.
Wait a minute. If we find a solution, then we can't talk about the problem.
And if you do find that solution, by gosh, you should implement it.
Look, that I love that. And I learned this a long time ago, and many of y'all, you probably heard it, you probably know it, but I want to bring it up here. Especially in sales background, it's like, you can't get most of it off of you. I mean, sales is can be a manipulative process. I love salesmen. Don't misunderstand me. I love salesmen. We go shopping. I want a salesperson. I want a professional salesperson. Okay, personally. And I expect them to be professional. They know what they're doing. They have experience, and I embrace that and I enjoy that. Okay, I want someone knowledgeable and that is paid well for their knowledge and therefore my experience, short and long term. Yep. Okay, so there's primarily two motivating factors, fear of loss, or I want to say greed, but I don't really like the word greed, for gain. All right, and which one's greater? So let me ask you. So let's say I called you at 2:30 in the morning and said, Ryan, man, there's an incredible opportunity. You know, we can buy Bitcoin.
Oh gosh, you're stacking the deck in this example.
I don't want to stack the deck. Okay, I call you at 2:30 in the morning, and I'm like, Ryan, somebody wants to give you a brand new car, right? That's exciting, right? And you would probably say, James, it's 2:30 in the morning. You know, can you call me in the morning, right?
Yeah.
All right. Now, let's say you have the brand new car, and I'll call you at 2:30 in the morning. I'm like, Ryan, somebody's stealing your brand new car. By God, you'd be out of bed. Thanks for the call. So,
yeah, the fear of loss is more intense than the prospect of a positive opportunity.
Right. And Rothbard is like, you're being ripped off, right? And educating that. It's like, it's almost not real. It's not immediate. You know, if I call you at 2:30 in the morning because someone's stealing your brand new car, I mean, that's immediate. You need to get out into your front yard, get out the door, whatever, and stop that. Right. But in the financial world, in this construct that we live in, you know, you're dying a death of 1,000 cuts, whatever that, you know, you're being bled to death over a long period of time, very slowly.
Yes.
Well, my God, that's how a tick can live on a dog.
Yes.
You know, it's a long time, but you put enough ticks on the dog and the dog will die. And I'm reusing the tick, the parasite, and the host because big government, constructed financial world, they're parasites and we're the host. You know, we're being bled to death over a long, slow period of time. It's like boiling the frog in water. You know, we've all heard that. Throw a frog in boiling water and he's going to do his best to jump out. Put him in cold water and turn the heat up slowly. We're boiled frogs.
Oh, that's so good.
Straight from Nelson.
That's so true. And
which is another thing too. We were talking about alternative things and, you know, fairy dust and education and making things look better than they are. You know, it ticks me off whenever people talk about the infinite banking concept and they're the expert and the guru and they never met Nelson and they haven't read his books or understand that becoming your own banker is so not about interest rates of return. Does that mean life insurance is bad and it doesn't have an internal rate of return? None of that. It is good. It does have an internal rate of return, and you can compare it to everything that you do. But whenever I read books and they don't mention Nelson, or they give him a cursory mention in the back of their first book, but nowhere in their second book, or they've come up with this great idea, or I just shake my head, and it's like they're part of the problem.
Yes,
I
agree.
You know.
So you mentioned one thing I wanted to touch on too about the intimidating conventional paradigm, and what came to mind as you were talking about it was the normal sales pitch. You know, they have a sort of and they vary company to company, but they're all kind of the same. There's usually 3 phases, right? They tell you that you're going to go through. So phase 1, you should get necessary protection, right? Insure your assets, get the homeowner's policy, the umbrella, all of that stuff. And then once you're out working, earning income over the course of your life, that's your accumulation phase. That's the second phase, right? You're building up assets, of course, suboptimally, but whatever. You're building up assets. And then in phase 3, the last phase, the idea is to distribute those accumulated assets, draw down those assets, right? Okay, so get an idea of what that chart looks like in your mind. It goes up, right? Over time, you accumulate more financial value, and then towards the end of your life, now that value goes down. Okay, to me, what that means is you're putting me in an economic class and programming me to think that I'm staying in it, right? I'm going to accumulate some wealth. I'm starting where I'm wherever you happen to be, right? And I'm going to accumulate some wealth over the course of my life. Then I'm going to draw it down, right? So I'm going to return to where I'm starting, right? Just later on. And then we've financed the interim period. As opposed to IBC, right? Which is a constant, steady, guaranteed exponential curve up and to the right. Eventually there will be a little blip where you'll pass away, and then a new curve will start over again at a higher level and continue to go straight up. Okay, so that to me sounds like a projection, a path a way of thinking to where I want to transcend the economic class that I'm in.
Oh my gosh.
I don't want to just accumulate and then draw it down and leave and have my kids be in the same scenario that I was in. Like, no, how about it all should be better from here on out, right? But how would you ever fit that into what is fundamentally an intimidating approach?
What do you mean fit that into?
Well, that's positive. That's like, things can be better.
No, that's exactly how you fit it in. Wherever, I did a talk one time called Meeting the Client Where They're At, and I understand the improper English and grammar, but that's exactly my point. We're all doing what we're doing for whatever reason, on purpose, by accident, out of ignorance or unknowing. We're all doing whatever it is we're doing. That's exactly where you start, right? Where the client is, where we're at, where you're at when you discover this idea and you research it and you vet it and you decide to implement it, right? Wherever you're at, that's where you're at. And you can exactly bring in this idea of what you just went through of transcending the financial construct. Oh my God, I love that. I think we should title this podcast Transcending. But it was supposed to be simple. Why would we even do this? But I think if you listen to this podcast, this is exactly why you should do it. But let me also say that yes, that can be brought in, this idea of transcending the financial construct, where the exponential curve continues beyond your life. Now we're talking generational, page 70, 71 in Nelson's book, Becoming Your Own Banker, an even distribution of age classes, which has its background in forestry and Austrian economics and life insurance. It's 2 or 3 pages. It's, oh my gosh, you can't read that enough. After you read it a few times, it's okay to go back and visit these things that Nelson pointed out. He wrote very simply, very succinctly, so I'm just saying they're easy reads. Okay. We actually do have primarily, fundamentally, in our financial life, an accumulation phase, right? But now the financial world has put us in this box that we need to retire at age 65 or 70 or whatever, thus ending the accumulation phase, and then going into the distribution phase, so you can transcend that, and it is possible to accumulate beyond that, age 60, 65 or 70, right? So my point being is that we do have typically an accumulation phase and a distribution phase, and that makes very simple sales concepts for the financial salesperson. Let's accumulate this away and then distribute this away. You can transcend that, and you can accumulate and distribute at the same time. And an efficient manager beyond more than one generation. And that absolutely transcends this financial construct. Oh, but wait, and then I get to be free and independent when it comes to money on top of that? Oh, and I'm controlling the banking function as it relates to me in my life? Oh my gosh, because I'm not using all these financial products that limit my access and my control and increase the risk and increase the fees and, put that bridle on. Oh my gosh. Okay. Listen, we can keep going. I got a couple of trigger words that I can throw out and get you going. Okay.
I think we touched on a lot of them. Capitalization versus investing. Capitalizing is good. It's going to improve your approach to investing, whatever it is you're doing. We didn't even touch on much of entrepreneurship, but the reason that the major financial companies don't even discuss it, the reason it's not on the table, the reason people are encouraged to just go be an employee somewhere, nothing wrong with that, right? My mom's an employee, nothing wrong with that. But the reason that the idea of entrepreneurship isn't even on the table is because you got to finance that kind of stuff. You have to capitalize you have to utilize capital in order to finance some entrepreneurial venture into existence. And so if a capitalization strategy, accessible financial value, if that's not part of your strategy, well then of course any kind of entrepreneurial venture is off the table, right? And I think that's a big reason why there's this, that you talk about the construct of, look, go to school, get good grades, work hard, graduate, get a job, work hard, make some money, retire poor, and then eventually graduate,
get
right?
a part-time job.
Yeah. But I think the reason that entrepreneurship is left out of that conversation is because we don't talk about capital. If you don't have a conversation about capital,
well, that's part of the reason. And two, what does the financial world provide to the entrepreneur other than loans, third party capital? And then shares or participation in their opportunities. I mean, what does the financial world really provide the entrepreneur? Access to capital and exposure to their opportunities, which fits in the paradigm that we have just talked about.
Yeah.
Right. So, there's a lot of things we didn't talk about. Entrepreneurship is one that we should, rail on for about 40 minutes sometime, not today, or not in this.
And here's another one, too, for the people who don't like whole life. It's naturally inflation hedged.
What?
Oh, my gosh.
We didn't talk about
you pay in the same or a decreasing amount, and you get more and more benefit over
Now, wait a
time?
minute. Let's say I'm paying a round number for me, $10,000 a year in premium. I don't care if it's paid monthly or whatever. My example, I'm paying in $10,000 over my lifetime, which completely blows up this pay 4, pay 7, pay 10, and go buy another policy. No, I want to pay as high a premium as I can possibly wrap my mind around for the longest period possible. Now, think about this. And it's the same with the mortgage, okay? I'm paying in $10,000 a year. What is $10,000 going to be worth in 15 years? Throw out a number. You're an economist. Come on.
I don't know.
Not much.
Half of what it is now.
Yeah, if we're lucky, 15 years. Yeah, that's maybe, or a third. I don't know. So let's say half. I'm paying in $10,000 today. The purchasing power of the $10,000 today, in 15 years, that same $10,000 will have about a $5,000 purchasing power ability, right?
Mm-hmm.
Okay. Now, I'm paying depreciating dollars in premium, and my cash value is appreciating, accumulating, compounding forever. So, wait a minute now. You think about this. You want me to limit how much I can put into a policy 15 years from now?
Ooh.
Oh, my gosh. The people who talk about that, pay 7, pay 10, get everything you can in the first year in cash value and don't pay. You're violating Nelson's 4 fundamentals.
Mm-hmm.
And you're also violating this truth that the purchasing power is decreasing in the future. Those dollars are going to be worth less. And therefore you're limiting, if you do short pay or limited pays or whatever, you're stunting that. You are limiting, you're stunting, you're retarding this exponential curve that can go beyond your life into maybe first, second, third generations.
Absolutely. I mean, paying for something with depreciating dollars and getting more of it back.
That's a hedge against inflation.
I mean, it shouldn't even be. It's honest. Doesn't even sound possible.
Draw me a chart out. Draw me a chart. Give me some numbers.
I want to plot that on a
That's what I'm asking
cumulative premium. I think it'd be a pretty picture, but
yeah, it would be a pretty picture.
All right, I've discussed my full page of notes.
Oh, I made notes while we were talking. All right, I had fun. I hope you did too. Yeah. Thank you for listening, and we'll see you next time.